What is investing? Investing entails setting aside some of your money and setting it to work for you. When you are investing in something, you are effectively buying into something, believing it will be more valuable in the future. Investing has the potential to generate a better return than a savings account. While your money's not locked away, you should be prepared to set it aside for at least 5 years to give you the best chance for it to grow. And keep in mind, the value of investments can go up or down, so you could get back less than you initially invested. What sorts of investments could you invest in? Well, the usual investments such as gold, real estate, stocks or crypto merely scratch the surface of the options available. Instead of overwhelming you with all the investment possibilities, let's focus on two well-known ways to invest: funds and shares. What are funds? Investing in funds means you're investing in a mix of assets. These assets may include shares, property, government bonds and cash. Investing in funds saves you the hassle of attempting to choose your own holdings. Another excellent thing about funds is that you are not placing all your eggs in one basket. It's wiser to put money into numerous resources, because if some of your assets lose value, others may gain value. That's called diversification, and it can be an effective method to protect your wealth, since if some of the investments drop, others may do well. There are two main types of funds. Funds that choose which shares, bonds or other assets to hold and monitors them on your behalf. You pay extra for the expertise of the manager with the intention of achieving returns that surpass the market. A passive fund or an index fund just follows or tracks a particular market or index. As the passive fund manager does not make any active contribution, passive funds inherently charge less than active funds. The rate of risk varies for funds from cautious, at the low risk end of the spectrum, to adventurous, at the high risk end. If you are younger, you may have more time on your side to deal with turmoil. This may make it worthwhile to think about a more adventurous fund. As you get closer to retirement, your investments could have less time to recover from any dips, so a more conservative fund may be appropriate. What are shares? Shares are units of ownership in a company. When you buy shares, you essentially buy into a company. Companies sell shares to raise money which they use to invest in new business plans. Investors, known as shareholders, are then at liberty to buy or sell any or all of that stock at any given time. The company's profitability or anticipated profitability will lead to increased demand for its shares, pushing share prices up. If the company's performance is poor or is likely to deteriorate, share prices could drop. Interest rates and the general economy can also affect share prices. The price per share of a particular investment is dependent upon market forces, so the value of an investment may rise or fall over the short or long term. While the income that you spent has the potential to increase, it also might decrease in value, meaning you may return less than you invested initially. What do you want from an investment? There are two main ways you may make money from an investment: via growth, also known as accumulation, or via an income. If you're considering funds, this means choosing between an accumulation or income fund. An accumulation fund is used to bolster the profit generated and added back to the original amount invested, thus making your investment more likely to increase in value. With an income fund, any income the fund generates will be paid directly to yourself. Investing for growth could be good if you're able to invest over a longer period, as accumulation funds may provide you with greater returns in the long term. Whereas investing for income could be a good short-term strategy if you are nearing or in retirement. By choosing funds that pay dividends, you could receive regular payments to boost your existing income or pension. If you're considering shares, you also need to decide whether you're investing with the aim of achieving either growth or income. Bear in mind that carrying out in-depth research on stocks can lead to a stock portfolio that will make it possible for you to weather the ups and downs of one individual company. Is investing right for you? To figure this out, start by asking yourself a few questions. 1. What's your current financial position? If you have interest-bearing debts such as credit cards and loans, you ought to pay them off and put cash away before beginning to invest. Ideally, you should have a short-term reserve of savings that could sustain you for 3 to 6 months of living expenses. This way, you'll have access to money to cover unforeseeable expenses without having to dip into your investments. 2. What are your goals? If you'd like to get enough money in the short term to pay for a new car, a vacation, or even a wedding, then investing is probably not the best thing for you. However, if you're putting money away for more long-term goals, such as a child's education or just more flexibility later in life, then investing may be right for you. The sooner you start and the longer you can leave your money invested, the more time your money has to grow. 3. How do you feel about risk? You aren't guaranteed any return on an investment. By putting your money into something you expect to increase in value, you are exposing yourself to market uncertainties, which means that the value of your investment could go up as well as down. As a general principle, higher risk investments such as stocks can result in higher rewards. Lower risk investments typically result in lower returns. You can begin by investing a relatively small amount of money, so starting small will get you accustomed to the investing process and allow you to make bigger investments further down the line. Thank you for listening, and please subscribe for more.